as promised, we have kept people here for a long day, but we have a grand finale to wrap this session up. And in particular, we have Congressman Jim Himes as our keynote. I think he's, sort of really is quite unique in terms of having a perspective that really very much bridges the worlds of private finance as well as the public sector challenges, and as a result, we'll be very interested in hearing what he has to say. It's a long resume with lots of things on it. I won't sort of belabor it. He represents the 4th Congressional District of Connecticut. He's in the 2nd term of Congress, serves on the Financial Services Committee. He's a product of my institution. And a Rhodes Scholar. He's spent a fair amount of time both in the world of private finance and at Goldman, ultimately heading up the bank's telecommunications technology group, as well as also running the New York City branch of the Enterprise Community Partners, which essentially was, I guess you'd describe as sort of social venture capital in the sense of trying to address some housing needs. So, without further ado, we'll turn the floor over to Congressman Himes. Thank you very much for coming.
Thank you. Thank you, Josh, and I'd like to thank Brookings for inviting me to participate in frankly, a day I wish I could have been here for more of it. It sounds like it was quite interesting, and as you're more than aware, and as I'm very aware, with Congress's 12% or 11% approval ratings, I accept any invitation proffered, so thank you for that. And it's actually a thrill to be part of this because I think I can bring to you a perspective perhaps that you haven't heard today. I can't tell you how the Jobs Act or parts of the Jobs Act are likely to affect over time the capital markets. I have my biases and my guesses, but of course so much of the rule writing has yet to be accomplished, and we will see. And I'm not, unlike some of the previous speakers, an academic. What I can do, though, is give you a little bit of a sense for how the Jobs Act went through Congress, because it went through in a pretty remarkable way. And the way in which it went through Congress, I think, offers some lessons for those who are broadly interested in public policy. And if our objective collectively, of course, is to establish a regulatory regime and to set the stage for truly vibrant, competitive, and liquid capital markets, I think there are some things that can be learned. Anyway, as Josh mentioned, maybe apart from sort of having been there at the conception of this legislation, maybe I can bring something of a unique perspective because, as he mentioned, I spent 12 years at Goldman Sachs in corporate finance doing IPOs and working with, in particular in the technology area, companies that were just sort of emerging from the angel and venture phase into something larger. So if you note a trend in my career here, I've gotten Goldman Sachs and the House of Representatives. I'm looking for the trifecta of truly reviled professions. So suggestions for the third are more than welcome. Bookie, whatever. And let me start by saying that I am a qualified. I was pretty intimately involved in the writing and all of the legislative work that was done in the Jobs Act. I am a qualified supporter. I actually think, on balance, it is a good thing. I have my qualms, as many observers do, about certain aspects of it. And I'll touch on those briefly. But the theme that I want to talk more about is really the fantastic measure in which it was sort of shepherded through Congress, sold to Congress. I don't mean fantastic necessarily in the good sense. Perhaps it was good, but it was also involving a certain amount of fantasy that I think can help us think through how we think about policy, particularly regulatory policy. A couple of my own observations. I'm going to close with kind of 5 of my own recommendations for public policymakers, but let me set the stage by just offering you my opinion on what was done. Ironically, I think in the Jobs Act, though it emerged from something called the IPO on-ramp, which was this sort of odd amalgam of the Obama people and lots of lawyers and venture capitalists and others, particularly in Silicon Valley, ironically, though the focus is on IPOs, or at least the popular focus is on the IPO on-ramp elements of the emerging growth company in particular, I actually suspect, and in talking with market players, think that probably the more significant long-term impact of this act will be the crowdfunding, which I know we were just talking about, provisions, as well as probably increasing liquidity and availability in the private market, Reg A, Reg D, 144, 144A. And I suspect those will be on balance good things, which is why I have the opinion that I do, fully cognizant of the fact that there will be, from time to time, absolute catastrophes of fraud that emerge as a result of crowdsourcing, and probably as a result of people marketing in ways that they were never permitted to do before private offerings. But of course, this is the balance that we strike as we think about regulations. On the IPO side, I must say I'm somewhat ambivalent both about what the Act did in statute as well as its actual likely application for a bunch of reasons. One, I worked hard both in committee and on the floor. I offered amendments both times to actually try to create a category of emerging growth companies that would in fact be emerging growth companies. And I had a line that was getting a certain amount of laughter in both venues where I was saying, look, when you've got $1 billion in sales, you have emerged. And you're not probably quite exactly that sort of Hewlett and Packard in a garage in Palo Alto that we're envisioning or talking about here. Something like 70% of all U.S. IPOs, at least in some time period I looked at of 2 or 3 years recently, were of companies with revenues less than $1 billion. And so it's important to understand that because of the definitional, because of how we defined emerging growth companies, we are actually talking about most of the IPO market here. I'll sort of leave that there. I'm not sure if that's good or if it's bad. But the other thing, of course, and those of you who read the New York Times this weekend know that it's not at all clear that companies that are emerging are necessarily going to want to take advantage of the exemptions that are provided to them as a result of the Jobs Act. Certainly at Goldman, when we did 144A offering memorandums, they looked exactly like SEC filing memorandums because we didn't want any sense that this is a second-rate, a B, a JV, a little boy type company. And so I think for those reasons, it's probably actually not likely to have a tremendous impact in the public markets. Whether or not, and this is of course one of the key questions and why I say that this act, which I support and voted for and helped on, was sold somewhat fantastically, whether it really helps solve the issue of reduced volumes of IPOs in this country over time, I just don't know, and frankly I'm a bit skeptical of that. The academic research out there, of course, doesn't unambiguously point at the conclusion that Sarbanes-Oxley is a meaningful impediment to filing an IPO. There are all sorts of other things, order handling rules, the change in the nature and the regulation of research entities, how the buy side thinks about the sell side that I think drive that. And again, this was sort of sold fantastically. If I saw it once, I saw it probably 24 times presented to my colleagues, a chart showing IPOs in 1998 and 1999, the height, of course, of the IPO tech boom. And look at this. In 2009, there's been a substantial reduction in the number of IPOs. And depending on how much caffeine I had in me at the time, I might sort of sarcastically ask the question, well, 2009, wasn't that also, didn't we also have a financial meltdown and unparalleled since 1929? They'd get all flustered and whatnot. But believe it or not, it was accepted amongst my colleagues as dogma that Sarbanes-Oxley was primarily or meaningfully responsible for the reduction in IPO volume. And by the way, those numbers, as you know, are somewhat ambiguous. It is pretty clear that smaller company IPOs over time have declined. Actually, frankly, a decline going back well before Sarbanes-Oxley existed. But we sort of accepted that. And we sort of accepted that if we just lifted that regulation, that would meaningfully help. Well, we'll see. We also never stopped to consider some of the other premises that were offered up to us. That an IPO, of course, is the route to maximum job creation. And frankly, the White House was somewhat complicit in this. They had a report in one of their commissions that said maybe up to 22 million jobs have not been created because of this challenge in the IPO market, which, look, Vice President used the word malarkey. I'll let... I suspect it's not quite that simple. But my point is a broader point, which is that it is not clear that for any given company, the IPO route is A, good, it may be, or B, better from a job-producing standpoint. Maybe a Reg D offering is the way to go. Maybe an angel offering is the way to go. Maybe a strategic sale to a large acquirer is the way to go. One of the things I'll conclude with here is that we shouldn't allow the Congress or policymakers to just sort of join this religion of IPOs create jobs. I like IPOs, but they are one of many tools in the toolbox. And you should understand that, a collusion of, I think, some enthusiasts in the White House, the industry, and an awful lot of us sort of didn't critically examine the extent to which, A, it's true that IPO volume is down because of Sarbanes-Oxley, and B, that adjusting that would somehow have a positive effect. So I guess before I get into my 5 quick recommendations from a policy standpoint, I think it would be helpful if we took a much more disciplined approach, a much more principled approach to thinking about the array of tools that exist for young companies to be financed. This is a personal bias, having done some of these IPOs. If you're a $75 million market cap company, or would be a $75 million market cap company, when you layer in the regulatory burden that most of us would agree is simply appropriate because you are selling securities to widows and orphans, when you layer in the hassles of having to report to the street, of having to report to shareholders, of all of the attributes of being a public company, there is probably some number that the professors in the room can tell me what that number is, below which it just doesn't make a lot of sense to your cost of capital to be public. And that, of course, would point you in a certain direction. We need to think more in the Congress and amongst the staff and among the regulatory agencies about that whole toolbox and what the characteristics are of the companies that make one tool more or less appropriate. And by the way, we ought to step back and say we've built this incredible apparatus, this Rube Goldberg machine of regulation, that kicks in depending on whether you're borrowing or issuing equity or whether it's big or small or you're public or private. We ought to have somebody step back, and maybe actually that's the point of this conference, and say we need to think about this holistically. Are we, apart from maybe favoring, as we did in the Jobs Act, one mechanism of financing, is our whole system picking winners and losers, if you will, amongst the different financing tools that one has? We ought to consider that. And I'll have one of my recommendations is relative to that. The other thing is we need to think, if we are truly interested, as I think we all are, in making our capital markets efficient, we shouldn't just focus on the regulatory regime. That, of course, is easy to do when you're in a Republican-controlled House. It's easy to do in a moment in time like this one where many of us, believe it or not, are desperate for bipartisan legislation because, of course, if you can get a bunch of Democrats along with the Republicans who are sort of temperamentally anti-regulation, you can really move something, which is, by the way, why I'm going to make some of the recommendations I make. But what about the other stuff? I had the temerity, and I think I embarrassed some of the IPO on-ramp people in a hearing in which I asked, well, what's your best guess as to the overall cost of being public, upfront and continuing costs? And the numbers sort of range between $1.5 million to $2 million. And then I asked a math question. I said, okay, the mean IPO in the last 3 years has been $400 million. Gross spread on an IPO today is remarkably consistent at 7.5%. Interestingly enough, 20 years ago when I was in the business, the IPO gross spread was 7.5%. We'll talk about that later. But what's 7.5% times $400 million? It's a big number, $30 million, right? Why are we not talking about this? Are we convinced that that $30 million, which, by the way, if your cost of equity is something like it perhaps is, 20%-ish, more maybe, what is, a perpetuity of $1.5 million a year that you pay to be public relative to that $30 million foregone proceeds right up front? We didn't ask that question much, interestingly. And by the way, maybe we shouldn't. If we're convinced that that gross spreads and that fees associated with capital intermediation are purely the product of a competitive market and that that's a competitive equilibrium, as a Democrat, I'll be the first to say, well, maybe I wouldn't be the first, but close to the first to say that that's probably not an area in which the government should take all that much interest. But again, as I said, the gross spread on IPOs have been remarkably consistent over a long period of time, probably worth thinking about. So 5 recommendations that I think are interesting, at least, in terms of informing policymakers. Number 1, I've characterized in a somewhat jovial way the way in which I think an on-balance piece of good legislation was sold to the Congress. And that's okay if, like me, you believe that on balance the Jobs Act is a good thing. But it's not okay, of course, as a procedural mechanism, because not everything that gets presented, and some of you will not share my opinion that the Jobs Act was a good thing, that's actually not a terribly good way to legislate. So we need a lot more education of members of Congress. And institutions like this one can do, I think, a lot more to create nonpartisan, academically driven, but here's the key part, understandable ways to think about very technical topics. One of the reasons I get invited to these conferences is because I may be one of the very few members of my 435 colleagues who actually enjoys diving into the details of more esoteric and technical financial regulation. But there's remarkably little information provided to us on these issues. Hearings don't do it. Hearings are political events, and you can glean information in hearings, but more often than not, they're a little bit of a debate that has been set up by the leadership of the two parties to bring out opposing views in a way that is not designed necessarily to get at reality, but to sort of establish a record that 2 years from now you can point to as a record. So we need a lot more education, not just of members of Congress, by the way, but of the media. For too long, and still, as we think about financial regulation, as we think about Wall Street and Main Street, as we think about the banks and the investment banks and JP Morgan Chase and Goldman Sachs, in my world, it's a morality play that roughly breaks down along partisan lines, or it does break down along partisan lines. It's a question of who gets to play God and who gets to play the devil. But here, coming out of the disaster that we had in 2009, of course, are the Democrats saying that Dodd-Frank is received wisdom, unalterable and unamendable, and here we have the Republicans on the other side saying this is satanic and terrible and horrible and it should be repealed in its entirety. And of course, that's the nature of the dialogue that all too often the media stokes. One of the things I try to do in Congress, and it's partly my background, it's partly the place I represent, to which financial services is very important, I try to find ways to carve out that question of what are the win-wins there. What is there not just to protect people, but will ultimately lead to lower cost or greater availability of capital. And that's very hard to do when the media and the information all out there falls into the morality play that defines the discussion that we have around financial services and regulation. So we need more education, both of members and the media, on these topics. Secondly, and I alluded to this before, but we really need to consider the whole toolbox of financings, from angels to IPOs to strategic takeovers. And as I said before, do an analysis of our overall regulatory structure and say, are we favoring one form of finance inappropriately over another? And by the way, that leads to asking some even more profound questions that Sheila Bair did in her new book, Bull by the Horns. Sheila Bair came out and said, we ought to stop tax subsidizing debt. Now, I'll be careful here. I read that, and that's what she said, and other smart people have proposed it. But I think we ought to do that kind of holistic examination of the various forms of subsidy and incentives and whatnot that we give different forms of financing, and really scratch our heads and say, does this help us from a public good standpoint? This town, of course, is full of people who will tell you that it's important from a public good standpoint, but what they really mean is it's important to their association. But I have never seen sort of a comprehensive treatment of here's what you do as a government and as a regulatory structure, here's who are the winners in this system and who are the losers, and you should think about whether that's appropriate or not. Third, it's worth considering, and I try to say this, I'm a Democrat, but I try to say this with as little partisan of a lens as I can. It is worth considering that there is a natural alignment between the anti-regulatory ideology of the Republican Party, certainly today, and the very powerful associations in this town, the bank lobbies, if you will. And I don't say that disparagingly. I work with them. They're important to my district, so I'm not sort of trying to fit into this morality play. But I am trying to say that it is worth considering as we think about examining that whole spectrum of regulation and different financing devices, how is the playing field tilted? And it is tilted in deregulatory ways. This Congress, the 112th, as we draw to a close, was arguably the most partisan of those 112 Congresses, and yet this piece of legislation shot through Congress and was signed by the president at an unbelievable pace. And, you know, ideas like reducing the definition of an emerging growth company from $1 billion to $750 million weren't even considered. Not only not by the Republicans, I couldn't persuade too many of my fellow Democrats that we ought to slow it down and consider these things, if only because here we were moving a piece of bipartisan legislation in this Congress, and isn't that a good thing? So when you have the natural axis that exists between the associations and the natural ideology of the Republican Party, and I'm using my words carefully, there are plenty of Republicans who understand the importance of regulation and whatnot, but nonetheless, the overall current there is a very powerful one. So when the White House says, we like this piece of legislation, it's done. And some of you will have heard this story. You know, many of the people who were intimately involved in crafting the ideas behind the Jobs Act on the definition of emerging growth companies, they said, well, I'll tell you what, we're going to ask for $1 billion in the House. And so, in fact, that's how it's drafted, even though that's kind of a crazy idea. But, you know, it may not get through the House. And you know what? If $1 billion in revenues for an emerging growth company gets through the House, they'll certainly stop it in the Senate. Well, we didn't stop it in the Senate. And again, I'm not trying to cast any sort of aspersion here. I'm just trying to illustrate the fact that that is a dynamic that we should be conscious of as we think about regulation. Fourth, I'm convinced that financial regulation is different from other regulation in at least two ways. One, the intense interconnectedness of the financial ecosystem makes it different. And in many regulatory areas, it feels to me like we're turning a knob. And the results of turning that knob, increasing regulation or decreasing regulation, are fairly predictable. You know, dangerous electronic appliances. You know, obviously we don't want electronic appliances that burn people's houses down. You know, turn that knob too far, though, and it's going to be hard for people to afford electronic appliances. Turn it too far the other way, you're going to get too many house fires in a way that is probably fairly predictable. The same is true of, and I set aside climate change in making this statement, but with environmental regulation. You know, we can predict, depending on how you regulate emissions from coal plants, exactly the particulate matter in the air and the effects on children with asthma and that sort of thing. I think financial services are different. I don't think it is subject to that kind of linear precision. I think, as we've all observed now, that you reach a point in the financial services industry where you get some combination of dialing the dials back and you no longer move proportionately. You move in dramatic step functions. And because of that, if for no other reason because of that, I think we should tread far more carefully in this realm of regulation. By the way, that's not to say that getting our air quality right is less important. I'm just saying that because of the disastrous consequences of turning the dial a little bit more, we should think a little differently about this regulation, maybe be a little bit more prudent, which perhaps informs the current argument that some of you are aware of between Patrick McHenry and Mary Shapiro. But I do think it's different. And by the way, it's also different. I stepped into the realm of partisanship. So it's also different in the sense that here we're not talking about business versus consumers. You know, we're not talking about the interests of the coal generation companies relative to the interests of people who live around them who might get asthma. Here we're talking about two different kinds of businesses. We're talking about the buy side and the sell side. And I think there's an opportunity there. And I think you see it. You know, the ICI and other associations that are there to protect investors' interests often will find themselves on the other side of the table from the issuers, from the sell side. And I think that perhaps offers us an opportunity to do what the implications of my previous statement are, which is to perhaps be a bit more prudent, perhaps help elevate this debate out of the morality play into something like, hey, you know, if we really get this wrong, if the Jobs Act turns out to be a colossal mistake, it will have been perfectly counterproductive because investors will say we are going to attach a substantial risk premium to an emerging growth company. We're going to attach a substantial risk premium to a crowd-funded company. You know, clear to me anyway that there's scope for more common ground there than there is in other forms of regulation. Lastly, my fifth recommendation. You know, as you can tell, I have certain ambivalence about the Jobs Act. I really think it's absolutely critical that we get regulation right. And I'm one of the few members of Congress who will say we need a vibrant, competitive, energetic, innovative financial services sector. It just needs to be safe. But as long as we're framing things in terms of jobs, let's not kid ourselves about how we, the Congress, should be spending our time. If we really want to talk about jobs, what we should talk about is innovation. And look, I think the Jobs Act on balance is going to do some good things, and I hope we do a lot more of calibrating that regulation. But what about innovation? What about the STEM challenges that this country has? What about the fact that our educational system is falling behind? To my money, there's lots of reasons why we're innovative. It's IP, it's bankruptcy law, it's our venture capitalist community, but at the center of that is our system of education. And I'll just close with this observation, and happy to take a few questions if there is time for that. The Jobs Act went through the Congress like a hot knife through butter, and yet we did not take up the No Child Left Behind authorization, where we could have really moved the needle on innovation and created long-term jobs, not because we got a regulatory balance somewhat better, but because we sort of changed the fundamental playing field for our people to be innovators and create jobs. So thank you, everybody.
So, Congressman, thanks very much for your frank and insightful comments. And before you, a bunch of economists spoke, but you used the word linear, step function, and equilibrium. So I think a lot of them were smiling along. Which,
there's hope for the Congress yet. Huh?
Exactly. But two quick questions to follow up on your points. You mentioned, as is often said, that we need to educate our representatives and the media on these complex issues. We try to do it at forums like this. Any advice in terms of what specific institutions work best to get congresspeople and their staffs information? We had some great PowerPoint presentations today by the speakers, I think, with some digestible points that could really shape the debate. What's the best way to get that in people's inboxes that makes a difference? And the second thing on emerging growth companies, where in government, are these conversations happening? You have the SBA, you have the House Committee on Small Business, the Senate Small Business and Entrepreneurship Committee. Where's the place in government where people are thinking about entrepreneurs and private capital first, as opposed to an and?
Yeah, the second question there is particularly good. Let me come back to that. So procedurally, how do you improve the education? I'm embarrassed to say this, but number one, start with the staff. We are not a government of experts. We are a representative government, and my colleagues look an awful lot like the folks you meet back at home. Spend a little more time raising money than they do, but other than that, very, very similar. So I think it's really critical that majority and minority staffs have relationships with institutions like this one and other institutions. You have an advantage. The SEC, the Fed, others do wonderful work in this respect, but they are, to some extent, part of the ideological battle, in the sense that if you're naturally deregulatory in outlook, you're terribly suspicious of stuff coming from the regulators. You, I think, you and collectively the NGOs and think tanks in Washington have a terrific opportunity to, and of course you'll all have your ideological stripes, but to build relationships, in particular with committee staff and with staff of members. And secondly, I would don't forget the members, and those who follow this stuff, much to my chagrin as a relatively new member, tell me that the decision-making power in the United States Congress is more concentrated in the leadership than it has been in generations. So that says something about focusing, of course, on committee chairs and ranking members and subcommittee chairs. And look, it's not easy. I mean, this stuff is really technical stuff, and a lot of my colleagues, and this is not in any way meant to be disparaging, have about 4 minutes to sort of listen to this, and when they hear the words jobs, they probably don't want to hear too much about 404B. And so it's a real challenge, but for some reason, it may just be the subject matter. My sense is that there are more people peddling thoughtful analysis on the Hill in the realm of national security, in the realm of overall fiscal issues, than there are people peddling, good financial calibration. Now, that's probably obvious, right? There is always going to be a fairly small minority of the Congress who focuses on that stuff, but I think we can do better. In terms of within the government, who's really thinking about emerging companies, I don't sense that, perhaps with the exception of a few people in the White House, than anybody is. It's not the SBA. I mean, the SBA does wonderful work for a certain category of companies. It's really not the SEC, whose mission is about investor protection, not about helping guys in a garage. And by the way, I'm not sure that that's inappropriate. The venture capital and the emerging tech community and whatnot are remarkably absent from Washington. Not entirely, and that's changing. It is changing. Silicon Valley Group is here now, and the Googles and the Facebooks are now deigning to open Washington offices and stuff because they realize that it matters. But those are big companies. The smaller groups, I think the National Venture Capital Association is arguing on their behalf, but it's pretty quiet. And I don't have the time to sort of suss it out, but that may be okay. That may be okay. I mean, the more Washington gets interested in what happens in Palo Alto and up on Route 128, it's possible that may not be a good thing for innovation. Yes, sir.
I have one suggestion. You talked about education or getting more knowledge, and one of my suggestions, I talked about it earlier on a panel, was why not try to increase the dialogue with the managers of public funds, the stewards of public capital out there, as a group that are involved in allocating assets. They also happen to be government servants, right? They're not in the private sector. They're not part of the banking community. But those are the people who are managing money on behalf of moms and pops, and they're also directly impacted by a lot of the regulatory reform that's taking place, and they can give you an idea of what they're worried about, where might be the unintended consequences, how do you, what you can do to kind of stop the bad guys, but also what you can do to potentially encourage good behavior, because you need to encourage good capital flows. I mean, you know that, I think, probably better than anybody.
Yeah, so you mean sort of the pension fund managers, the CalPERS of the world, and
CalPERS,
right?
and there's international institutions as well, and they're all interested in investing, and they're very concerned about protectionism. We've got this move towards regulation, which seems to be putting up barriers between the U.S. and Europe and other places, and restricting access, and we're worried about increasing costs and lowering returns, and the ultimate people are going to get hurt are the moms and pops in terms of their savings. So, how do we deal with that? And there is a lot of capital potentially that could be unlocked, and part of it also is how do we smooth the way for some of this in an appropriate manner.
Yeah, it's an important and very powerful observation. I talked about that morality play that unfortunately has set the terms for our discussion of financial services regulation. In that morality play, anything, and I'm exaggerating here, but anything that a money center bank or an investment bank or a hedge fund or a private equity institution tells you is, at least on the Democratic side, inherently suspect. On the other hand, if you get a fund manager for a union pension fund who comes in and explains this stuff, it just gets it's the Nixon in China syndrome. The unexpected it can be very, very powerful. And actually, they've played an important role, many of the public pension fund managers and that sort of thing. Very powerful effect. I mean, we see it today with CEOs who one might ordinarily associate with the Republican Party in town last week to say you got to raise revenue. That can have a tremendous amount of power. It's a really important thing. What often happens, though, is if a public pension fund manager or a fund manager or collectively fund managers are given limited amount of time to interact, sometimes they choose more parochial issues. It might be the structure of money market funds, money market fund regulation as the thing that they put first. So again, we sometimes find the overarching questions of, where are the real rigidities and frictions in capital markets being, the item you get to in minute number 29 if you have time, which is unfortunate.
Can I do one more question? I like the idea of approaching staffs. I will say, having done some congressional staff briefings, which were often fun, but the staffs are often very young, is what I'm struck by. That there must be a lot of turnover there, that new ones coming in every year and so on, that may make it difficult to accumulate that knowledge. But my question really is around, I actually wrote with one of my colleagues an op-ed in support of the Jobs Act, but like you, I had some reservations. And part of the reservation was around the misuse of this crowdfunding, that whether there were going to be adequate protections for bad guys, if you like, who were potentially able to take money from folks that really were not going to offer anything in return. Do you feel satisfied that those that can be avoided, or that there were enough restrictions or regulations to prevent the misuse of that crowdfunding?
The House bill was dangerous as it passed the House, and I voted for it, by the way. This is one of the things you learn as a legislator, is you sort of, always hold your nose when you vote for legislation if it's meaningful legislation. I think the Senate bill and the ultimate bill was dramatically tightened in a way that I think certainly got me there. And I think that the SEC's approach will also further tighten things up from a standpoint of regulation. So, again, I hesitate to unconditionally say that we are where we are, and even if I were willing to say that, of course, we're still every 6 months going to be treated to some, crazy fraud, which, again, another topic for another day. The objective of financial regulation can't possibly be to eliminate the possibility of fraud. So I think where we ended up was probably a good balance, but that's actually the piece of it that worried me the most. At the end of the day, general solicitation, I don't want moms and pops to pose as accredited investors, but presumably there's some complicity there. I'm not too worried about the institutional investors. When you are talking about the possibility of fraud perpetrated in particular to retail investors, it's very, very serious. And I like you, am conditionally satisfied with where we are.
Thank you, and thank you so much, Congressman.
Thank you.
Really great to have you.